Hey, welcome to the 40 Finance channel, everybody. Hey, listen, we've seen a lot of market volatility over the past couple weeks. Some people are wondering which way this thing's going to go. And the truth of the matter is no one really knows for sure if we'd ever have a market correction or if things will keep going up. But there are a few warning signs to be careful of with your own stocks when you're kind of thinking about, is it time to sell? Is it time to buy? So I want to talk about 3 fundamental warning signs for stocks that you might be able to use in your own portfolio or when you're screening stocks. Fundamental signs that maybe the future doesn't project as well as the past. All right, the first one I'm going to throw on the board today is negative comps. And this is really important because the business environment last year was very different. Even heading into this year with COVID and the pandemic, there were a lot of changes to consumer behavior, and certain industries that did really well are facing a future perhaps where the pandemic is behind us, maybe consumer activity shifts again. So if you start to see a stock having negative outlooks for revenue growth, for example, then that can be a warning sign that the stock will either kind of get stuck in the mud or perhaps even go down as folks start to get closer to that fiscal year where there's those projections. All right, let me show you a couple examples of a negative comp potential. Now, this is based off projections, as so much of the market is. So these things can change. But right now we have Target. Had an outstanding past couple years as shoppers went to a lot of these big box stores, and Target expanded their e-commerce chain, all because they were kind of stuck inside, right? And that environment is changing a little bit. So a year ago, they had 942 on the EPS. This year's projection, 1301. So very strong growth there. But look at next year's average projection, 1292. So what would happen is this EPS would go down and your PE would go up. So Target would effectively become more expensive from a valuation perspective, and that would certainly put pressure on the stock price. Then we go down to sales. All right, year over year, if they hit their numbers, you're looking at plus 11% this year, which is pretty remarkable for a $104 billion company, right? They're doing a great job going from 93 to 104. But let's look at next year, 106, still growing, but only by a sliver, 1.7%. And if there were any unforeseen circumstances, then this could easily dip into a negative comp environment. All right, let's take a look at one more, Dick's Sporting Goods. Last year, $6.12. Almost doubling that EPS this year. In fact, more than doubling, at least on the consensus, $12.80. Next year, though, pretty decent drop, down to $9.39. Once again, your PE ratio going in the wrong direction. It's going up, and that's going to put pressure on the stock price. Looking at sales, they actually have a negative comp projected. So Target was at least projected to hit almost 2% in their comp, but Dick's is facing a minus 3.7% projection, going from 11.71 billion down to 11.28 billion. All right, the next warning sign I'm going to call a growth contraction. So with the growth contraction, you've had an awesome year. Let's say this year you're projected to have an awesome year like we saw with Target, plus 11%. But instead of going negative next year, your sales or the growth rate is just contracting. So it's going down. And with that, you're going to see multiples for stocks go down as well. So with the high growth stocks, for example, generally speaking, the higher percentage your revenue is growing, the higher a multiple people pay for your valuation. So if you just wanted to take a simple price to sales, if you're growing, say, at a 50% pace, or that's what the projection is for next year, you're going to have a very, very high multiple. But if the year after that, your growth pace comes down to say 20% or 10%, then the multiple that people are willing to pay to have a piece of that growth is going to go down, and that's going to put pressure on your stock price. Okay, a couple examples of growth contraction. AMD, great company, doing great things. They've got a pipeline of research and technology. I'm not saying that AMD is going to go bankrupt. Matter of fact, from an EPS standpoint, things look pretty good, going from $2.49 projected this year to $3.05 next year. But on the revenue side, or the growth side of things, most people are looking at revenue when they talk about growth. And here you can see AMD this year is projected to finish at plus 60% revenue growth, which is amazing, going from $9.76 billion up to $15.65. We look ahead to next year, still great, going from $15 billion to $18 billion, but that growth level significantly lower than what we saw in this fiscal year. So whatever multiple people paid for AMD, say 3 months ago, when they expected a 60% growth in sales, they're willing to pay up a certain point for that. Next year at 17%, they're still good. They're still in double digits, right? But I would expect that sort of price to sales multiple to come down a little bit, even though the EPS is going up. In this technology game, it's all about sales right now for most of these stocks, certainly the arguably overvalued stocks, and I would say AMD falls in that spot. All right, let's take a look at Apple for another example. Again, you've got positive growth on the EPS side, 559 to 568. Not a lot, but it's still going. That PE is coming down. But on the revenue side, there's not a lot of positive outlooks for Apple. 33% growth this year, which is probably one of the more impressive things that you're going to see in the business world, going from $274 billion up to $366 billion. That is monstrous. Approximately $91 billion in incremental revenue. Just don't see that one every day. And next year, hey, not so bad, growing up to $380 billion. But you talk about the change in growth rate, 33.5%. Next year, projection is 3.9%. So once again, we have seen with companies like Apple and AMD and several others to go along with them, during the peak of the pandemic times, these companies were trading at much, much, much higher multiples than we've seen in the past. And I figure that with these growth rates coming down some, and in Apple's case, dipping into single digits, I think you'll see a sort of return to the norm in the valuations that investors are willing to pay. All right, warning sign number 3, and this one's kind of arbitrary, and you really have to have the pulse of a company and probably be watching it for a while to really get the feeling for, is their moat shrinking or disappearing entirely, right? This is not something that happens in a single day. It can happen quickly, but normally it's just the addition of competition that brings a moat rating down. The important thing is that when you do see moats disappearing or dissolving, what it does to a company is it puts a lot of pressure on their profit margin and their retail pricing, right? So whenever competition comes in, you figure if you have a lemonade stand, you're the only one in town, you're charging $1 a cup or whatever it is, and then all of a sudden 5 more lemonade stands open and each one competes on price. The first one comes in and goes to 90 cents. Then the second guy does it for 75 cents. And eventually your $1 looks pretty bad unless you've got some sort of secret formula, aka a moat, that makes your $1 profit margin feel a lot better. But in most competitive industries, the addition of competition and pricing pressure will eventually bring down your margin. All right, so for this one, again, I'm just kind of picking arbitrary examples here. I think, in my opinion, Coinbase would be a company that would face margin or moat pressure as time goes on. They're a premium cryptocurrency service and marketplace. So anytime you're on the premium edge, you have to worry about undercutters coming in. And my understanding, while not nearly being a crypto expert, my understanding and from what I see in the market, there's a lot of providers spinning up, and you can kind of see some of this in Coinbase's projection. So this year on EPS, you got a projection of $12.65. And then look at next year, $6.12. That kind of cuts in half. Really hard to tell with a company like Coinbase because it is based on volume. I could see this one going either way, but you almost have to project the interest in the cryptocurrency market. And right now, analysts are saying that 2021 is a much more volume-orientated crypto game compared to what they expect to see in 2022. All right, then you scroll down on the revenue side, and again, declining revenue projections. I'll be fair to Coinbase here. I'm not sure how anyone could accurately project some of these revenue estimates, but we know one thing for sure in this use case. Coinbase effectively charges more for the same service other people offer. Now, there's a lot of people who will say the quality of the service is better, but eventually, as more and more cryptocurrency markets open up offering cheaper services, we can expect that Coinbase will have to lower their fees. It's really the same kind of thing as the Robinhood effect, right? We used to pay $25, $40 a trade back when I first started investing, and then Robinhood came out with free trading, and what did you see happen in the marketplace? Everybody's at free trading now. That may not be a next year thing for Coinbase, but it's certainly something to think about in the long-term future. All right, how about a company like Affirm, who's actually on fire with the buy now, pay later? And with buy now, pay later, Affirm and a couple other companies have come in and really put a stranglehold on the industry, and they were first movers to all this, and it's paying off big time. There's a lot of projections for Affirm to be a wildly successful company over the next 3 to 5 years. And right now, if we scroll down to their revenue, they don't have to go very far to be phenomenal, right? We're talking about a company that last year didn't even make $1 billion in sales. I'm not even talking about profit. This year, they're supposed to hit $1.2 billion in sales, and next year, $1.73 billion in sales. Now, when it comes to competition, we know that there's a lot of other people pumping into this space, right? This is a first mover advantage company with Affirm. But if we think about it from the Coinbase angle, you're going to have to battle a big dog eventually, right? So PayPal has buy now, pay later. Certainly hasn't been as popular in the headlines as Affirm has. Their partnership with Amazon, Affirm to Amazon, holds a lot of promise. But what really stops Amazon from doing this themselves, right? Then you get into Apple, buy now, pay later. There's a lot out there. And to top it all off, from the standpoint of like a long-term investment, there's storm clouds in the sky as soon as these buy now, pay later customers stop paying later. And that's when you're going to start to see the regulators come in and make the argument that, this isn't a free system and there's penalties and everybody's going to get involved because it's basically a banking related service. It'll have its day in regulation court, and we'll just have to see if it can survive. All right, so those are 3 warning signs to look at, maybe with your own stocks or stocks that you're thinking about investing in. You've got negative comps. That's when next year's sales are projected to be less than this year's sales. Then we have growth contraction, which means you're still growing, but what we just went through with in the pandemic, consumer behavior is changing. So what worked 2 years ago can still work today, but it's really hard to tell if it's going to work 2 years from now, right? So if you grow 60% this year, you know, everybody's cheering, but you really, at this point in October, we have to start thinking a lot about 2022 fiscal year to make sure that that growth has a chance to continue. And if it's going to contract, if it's going to come down from lofty numbers the year before, you can expect the stock price to be affected with that. All right, and the last point was moat / competition / innovation. Look out for moats that are maybe unstable, perhaps dissolving. I would argue that there's a lot of competition out there right now in fintech. I'd say there's a lot of competition in real estate. So, you know, I recently bought Zillow stock. I feel good about it. But let's not pretend that Redfin and several others exist too. So there's going to be pressure on Zillow to make either their product better or the pricing for their product better as time goes on. All right, guys, let me know what you think of these 3 stock warning signs. As always, please give the video a like, subscribe to the channel if you enjoyed the content. We'll see you on the next video.